Now you're working with relatively young companies as they're beginning to scale, and I think a lot of these companies have reputations of burning through cash relatively quickly. Is that a good sign, or how do you help companies as they scale growth to balance between their spending and getting up to a profitable break-even point?
It's a critical question. I come from the old-fashioned view of capital efficiency, high productivity, building huge shareholder value with small injections of financing. I respect the worlds of the Amazons and the Ubers that have these massive amount of funds raised and are really not profitable but high growth and massive market footprint. I don't know how to do that. I like the old-fashioned way of modest capital, hard work, great productivity, profitability, save, conserve, and build cash after you have to burn it for a short period of time. And I'm reminded of World War I when the British were criticized for not having enough casualties in the Battle of Somme, which showed they weren't trying hard enough. And that's the wrong approach in the startup world. Be capital efficient.
It's a great analogy. Not enough casualties, I guess, is one thing we want to avoid.
Yes, and you can run out of money way faster than you think.
So are we currently in a startup bubble right now?
Everybody has their own view. I strongly feel we are in a startup bubble. We've had a record amount of venture capital dumped into companies that aren't profitable, that aren't having exits. We have almost no IPOs. We have many fewer acquisitions than is said, and a whole lot of unicorns with no way out for investors. I think there's a big bubble gonna pop here, and I think Silicon Valley traffic patterns are gonna get easier for our commutes in the next year.
This is interesting as we're looking into the industry, and we hear about in November the revaluation for the unicorns coming out, and when we look at companies today, how does all this affect the fact that there are no exits?
It's a very, very serious problem because the venture capitalists promise their investors returns that are liquid cash. They have to return cash or public stock to their limited partners as a way to pay them back and reward them with returns on their capital. And if they have no acquisitions of their own investments and they have no IPOs, they don't have any value yet beyond just the paper stock certificate that they can give back to their limited partners. So there is an imperative to break the logjam in IPOs and to have acquisitions happen more frequently. And it's a puzzle.
The past few years, there's been a flood of money coming out into the markets, new startups happening, and what do you think is going to happen?
I think we're going to see a revisiting of the dot-com bust, not so much in dot-coms today, but in young startups that have raised too little and spent too quickly and have too thin a business model and didn't have a plan to win customers and turn profitable in time. I think you're going to see a lot of washouts intentionally let go by the venture capitalists so that they can concentrate on the stronger horses they have running in the race.